Good morning, ladies and gentlemen of Facebook. It is Adam here with the highest return, coming at you to talk about covered call options. Now, in last video, I talked about how call options can be used to make money if a stock goes up. Today, I'm going to talk about covered call options, which are actually my favorite type of option, which is a way to make money off of stocks you already hold. So, covered call. All right, so I'm going to give you three scenarios, one where a stock is going up, one where a stock stays the same, and one where a stock goes down, and what happens if you write a covered call option for these stocks. So the first scenario is when a stock is going up. Let's just say you wrote a covered call here for the stock to go up maybe to this point here. So what happens is you make this profit here, this line is what your profit you make, and if the stock goes above this point, you are forced to sell the stock for this price here. But as you can see, in a situation where the stock price goes up, not only are you making money from the premium that you received from writing this call option, but you're also making money from the further appreciation of the stock price here. So you end up, basically, if you draw a line, a straight line with the stock price, you make this amount of money regardless. So this is the point right here where the strike price is, so you make this money, and it's capped at this point right here. So again, this is the profit from the call option, but you're selling your stock for higher than when it was trading when you wrote the call option, so you still make this money as well. I'm just going to call that P2 and P1. P1 is the profit from the writing of the call option, and P2 is the profit from the stock going up, which doesn't always happen. So the second scenario, which is my favorite scenario when I'm writing covered call options, is the stock price stays exactly the same and you receive the premium for the call option. Let's call this P1 again. And then your profit is this line here. So what that means is if you're trading, or if you have a stock in multiples of 100, you can take advantage of writing covered call options to make a profit off of the stocks you already have. And premiums vary based on the volatility of the stock itself. For example, if you were, to write call options for Ford, your premium's probably not going to be very high because Ford is not a super volatile stock. If you're going to write call options for Tesla, on the other hand, then your premium is going to be very high, and you'll make a lot of money from writing call options for your volatile stocks. So this amount of premium that you get varies, but what I try to do is write covered call options for prices that won't be executed, so I can keep my stocks and make money on the stocks I hold every let's just say every 2 weeks. You can write covered calls further into the future, which will increase your premium. And if you write them into the short future, in the near term, then basically you get less premium, but you can write more options over time. So the last example, the covered call, is when a stock is going down. And so if I decide to write my call option here, and normally let's just say I would normally do it slightly above what it's trading at up here, what happens is I get my premium, and because the stock is lower, I'm not going to be selling my stock, but I'm losing money because I'm holding the stock. And I have to hold the stock unless I'm approved for naked short trades, because if you write a call and you don't have the stock to cover it, then your loss potential is unlimited in the situation where the stock goes up. So let's just say that I didn't actually hold the stock here when I wrote the call option. I do get the premium, so this is the break-even point where it goes to the strike price plus my premium, but anything higher than that is just pure loss into who knows where. So covered calls, nice to use to basically make money off of holding stocks, whether they pay dividends or not. You can make money off of them. Caveat is this doesn't usually don't have call options available for foreign stocks. For example, I have the maker of Lysol. I can't really pronounce the name very well. It's Reckitt Beneficer. And I can't write covered call options for them. I have some Tencent, which is a Chinese company. I can't write call options for them. But a few of the stocks that I have written call options for include Inovio Pharmaceuticals, stock symbol INO. When there was a whole fad and it was going up to the 20s, I wrote a call option, I want to say with a premium of $10 per share, which basically guaranteed that I'd make money off of the stock, whether it went up or down, because I ended up buying that share for $7 per share. So if you see froth in your portfolio, but you don't want to sell the stocks for maybe tax reasons, and you want to make money and capitalize off of a stock that you think is going to go down or stay the same, then I suggest writing covered calls. If you think that the stock's going to just explode, then don't write covered calls, because your profit is limited to this line here, and then you're forced to sell the underlying shares on expiration. So you may see that your underlying stock is making you tons of profit, but this covered call option will keep going down in value, and it's a negative value, because when you write it, you get money, so it's negative, and that negative amount will continue to go up, or I should say down, until the expiration date if your stock is above the strike price of the covered call. So like I said, good for falling markets that you don't want to sell shares, and good for stable markets where the share price is pretty much stable. This has been Adam with The Highest Return. Join my Facebook group if you want, and have a great day.